the stochastic oscillator by itself not only helps you to identify overbought and oversold areas, but it also provides you with 4 different trading signals: divergence, coming out of the overbought or oversold areas, crossing between the 2 lines of the stochastic, and all the signals in the direction of the trend. Your edge has been growing, and now it is time to combine the different stochastic signals with the support and resistance areas identified in the previous lesson and homework. This way you'll increase exponentially the probabilities in your favor. So I want to show you how. Here is a chart of the Euro US dollar. You'll see basically as you start the chart, you will immediately see that this area here has been an area of support, and you will notice clearly that that area of support, once penetrated, will become resistance, as you can see right here, right? Or as you can see right here, it was penetrated here. So now remember that lesson: support once penetrated become resistance. So the next time prices try to go there, it will find resistance there. Okay, so now let's look at how the market behaves with those areas and how we can use the stochastic. For instance, right here we had this support area and the market tried to go up. It does, but when it comes back down, it finds support in the same area of support. Now, notice how the stochastic down here gives you a buy signal, a crossing of the blue above the red. And it is in the oversold area, and on top of that, it penetrates the 20 reference line. So all in all, a buy signal. Since we are above support, we have to consider that all the buy signals that the stochastic gives you should be valid, legitimate signals to buy. Okay, so from here on, we find support here, and now from here on we find the buy signals from stochastic, and now we take all the crossings of stochastic in the upwards direction. So we buy every time the stochastic crosses. So we have a buy signal down here, we have another buy signal here, we have another buy signal here, we have another buy signal here. Notice that those crosses of the stochastic happen in the middle of the stochastic. It doesn't happen in the overbought or oversold, but it doesn't matter because we're trading in the direction of the trend. How do we know that? Because we're above support. And until that support is penetrated, we will continue taking those signals. Okay, once the support is penetrated, then now we cannot apply the same thing. So for instance, this buy signal here is not a legitimate signal to take. Okay, but notice what happens here. The support area became resistance, and prices down, prices continue to try to go higher and penetrate that resistance, previous support, and now that resistance becomes support. Now with that in mind, it means that the crossing of the stochastic, wherever it may happen, will give us a valid buy signal, and that's exactly what happened here. Stochastic crosses and we give buy signal again, so we buy again. Okay, what happened afterwards? Markets made a new high here. Stochastic could not do that, so you can see here the stochastic is on the overbought area together with this high, but this high, which is higher than this high, is not confirmed by the stochastic. The stochastic is actually lower, so that produced a divergence. Remember that concept of divergence? That means that likely prices are going to now go down. Now notice what happened. Where did they go down? They went exactly to the same area of support. This is not magic. This is something that happens all the time. This is the way that the markets behave. And since we are above the area of support, then we still take the buy signals of stochastic. And here we have another one where the stochastic cross again, and they actually penetrate the 20 reference line to the upside, and here we have another buy signal. So this is the way that you would use the stochastic in combination with the resistance and support analysis, and this is the way that you would bring an edge still bigger, still higher to your trades. You will increase exponentially your possibilities if you follow support, resistance, stochastic buy or sell signals depending upon where you are. Right? So with that in mind, developing this ability will probably take you several days because you have to place those lines where support is, where resistance is, and you have to do it in ways that is legitimate. You don't want to create something out of nothing. For instance, let's go back to this chart for a moment. We can see, for instance, this area here and this area here have been areas of resistance. So we can put another line there to see what happened with those areas of resistance, right? So you can see here was resistance. When the market tried to go back up, where did it go? To that resistance, and it found resistance there again. Once penetrated, that area of resistance becomes support, and so from here up we still have the trend as up. Okay, now prices penetrate that area of support, and now this area here is not a line, it's an area. This line becomes resistance. And when prices penetrated and try to go back up, again, find resistance in that area. And you can see that that happened not only as resistance, but also as support. Like, for instance, in this case, once that this area of resistance was penetrated here, now it became support. Notice that when prices came back down, it stopped there. Right? And once that area of support was penetrated, it went to the next area of support. And what happened after that? Prices recovered, but where did they go? To the next area of resistance. So that's the way that markets work. And there is a psychological reason behind that. Okay, a psychological reason that we could discuss in a different lesson. And as you can see, these areas of support and resistance work not only in the same time frame, sometimes it works for days, for weeks, for months, and even for years. Okay, those areas will stay as support and resistance because the markets have memory.